Welcome back to Financial Market Insights for Traders, the podcast where we dissect the markets to give you the edge you need. I'm Sophia, and today we're tackling one of the most common questions I get from investors. Should I invest in indices or ETFs for long-term wealth building? The appeal of passive investing has skyrocketed in recent years, especially in 2025, where market volatility is driven by AI hype, Fed rate uncertainty, and geopolitical tensions. Investors want stability, diversification, and set it and forget it strategies. But here's the problem. Not all passive investments are created equal. Indices and ETFs might seem similar, but they cater to different goals, risk tolerances, and trading styles. So today we're doing a deep dive into 1. What indices and ETFs really are beyond the buzzwords. 2. Key differences in performance, costs, and flexibility. 3. Which one is better for your strategy? 4. A surprising alternative for active traders, spoiler, CFDs. If you've ever wondered whether to buy the SP 500 index fund or an SP 500 ETF, or if you're curious about how to trade indices without owning them, this episode is for you. Let's get started. Section 1. Understanding indices, the market's report card. What exactly is an index? An index is like the market's report card. It measures the performance of a group of stocks. The SP 500? That's 500 large US companies. The NASDAQ 100? Top tech firms. The FTSE 100? The biggest UK stocks. But here's the critical point. You can't buy an index directly. It's just a benchmark. To invest, you need an index tracking product, like an index fund, ETF, or CFD. How indices are weighted and why it matters. Not all indices are structured the same. There are 3 main weighting methods. 1. Market cap weighted, most common. Bigger companies equals bigger influence. Example, SP 500, NASDAQ 100. Pros, reflects real-world market dominance. Cons, overexposure to giants, Apple, Microsoft. 2. Price weighted, old school. Higher stock price equals more impact. Example, Dow Jones Industrial Average. Pros, simple, historic. Cons, a $500 stock moves the index more than a $50 stock, regardless of company size. 3. Equal weighted, the underdog's choice. Every stock has the same influence. Example, Invesco SP 500 Equal Weight ETF, RSP. Pros, no mega cap dominance, better small cap exposure. Cons, higher turnover, more rebalancing. Why investors love indices. Diversification, one index equals hundreds of stocks. Lower volatility, less risky than picking single stocks. Proven long-term growth, SP 500 averages 10% annually over decades. Passive low cost, no need for stock picking or constant monitoring. The downsides of index investing. No control over holdings, you're stuck with the index's components. Market cap bias, tech-heavy indices like NASDAQ 100 can be volatile. No downside protection, if the market crashes, your index crashes. So indices are great for hands-off investors, but what if you want more flexibility? That's where ETFs come in. Section 2. ETFs, the modern investor's Swiss Army knife. What makes ETFs different? An ETF, exchange-traded fund, is like a hybrid between a stock and a mutual fund. It holds a basket of assets, stocks, bonds, commodities, but trades on an exchange like a stock. The biggest difference? ETFs can track an index, but they can also do much more. Types of ETFs, beyond just index tracking. 1. Index ETFs, mirror an index, e.g. SPY for SP 500, QQQ for NASDAQ 100. 2. Sector ETFs, focus on industries, XLK for tech, XLV for healthcare. 3. Thematic ETFs, bet on trends, AI, blockchain, clean energy. 4. Commodity ETFs, track gold, oil, or even Bitcoin futures. 5. Leverage/inverse ETFs for advanced traders 2x bullish, 1x bearish. Why ETFs are so popular in 2025. Liquidity, trade them anytime like stocks. Lower fees, Expense ratios often under 0.1% versus mutual funds. Flexibility. Want to overweight tech? Buy XLK. Betting on AI? Grab AIQ. Tax efficiency. Fewer capital gains distributions than mutual funds. The hidden risks of ETFs. Tracking error. Some ETFs don't perfectly follow their index. Overlap. Owning SPY, QQQ, and XLK. You're triple exposed to Apple. Liquidity gaps. Niche ETFs like thematic funds can have wide spreads. Transition. Brief pause, then shift to comparative analysis. Section 3. Indices versus ETFs. Which one wins? When to choose an index fund. Index funds, like Vanguard's VFIX, are ideal if you want the simplest, cheapest way to track the market. Plan to buy and hold for decades. Don't care about intraday trading. When to choose an ETF. ETFs, like SPY or QQQ, are better if you want flexibility, sector bets, thematic plays. Like trading throughout the day. Prefer lower minimum investments versus mutual funds. A wild card for traders. Index CFDs. Now, here's something most passive investors don't consider. Index CFDs, contracts for difference. If you're an active trader, CFDs let you speculate on indices without owning them. Benefits. Trade long or short, profit in any market. Use leverage, amplify gains, but watch the risks. No ownership costs, just spreads commissions. For example, platforms like crystalballmarkets.com offer tight spreads on SP 500, NASDAQ, and DAX CFDs, ideal for short-term traders. Conclusion, making the right choice. So, which is better, indices or ETFs? It depends on your goals. Ultra-passive investors? Index funds win. Flexibility seekers? ETFs are your best friend. Active traders? CFDs offer a unique advantage. In 2025's market, where AI and Fed policy dominate, diversification is key. Whether you choose indices, ETFs, or CFDs, the most important rule remains. Stay disciplined, keep costs low, and invest for the long term. If you're interested in trading indices with low fees, check out crystalballmarkets.com. Link in the show notes. That's all for today. If you found this helpful, subscribe and leave a review. Until next time, trade smart and stay ahead of the markets.